I have to go out again. I'm here though.
Greetings.
Yeah, look, we got the Yenny here.
We're live. What's up?
Right.
Let me back in when I fall out.
All right. Let's see an introduction, Fouts. What's going on?
You're muted, sir.
Can't hear him either.
Are you muted?
Let me hit my computer and see what happens.
Here you are. I think you're on now.
Oh, well, that's weird. Yeah. Well, welcome everybody to another Ask Me Anything. Apparently my sound is now working, so we'll go ahead and get going. But we're going to go ahead and go around the horn here in just a moment, do some quick introductions. Go ahead and get those questions into the chat box, and we'll start here in 14 seconds. All right, and we are back. All right, everybody, go ahead and please get those questions into the comment box there. And so if you guys have not been to an Ask Me Anything before or one of the live events, these events are for you to ask questions about, well, infinite banking, money, investing, all that kind of stuff. So go ahead and get those in there. So yeah, I'm Brian Fouts here, everybody up in North Idaho. Having some really nice weather this week, and it's really rare. It's usually raining and wet and cold, but it's nice. So everybody is... all my kids think that summer and spring is here, and they're going to get their hopes dashed here next week, I'm pretty sure. It gets pretty cold, but nice right now. So with that, Mr. Snaggy.
Hey, what's up, everyone? It's been a fun day today with all the webinars. Who caught what the F this morning? Anybody on Wealth Webinar?
Yep.
You know, Chris and Craig did a great job. I hopped on at the end to say hello and talk a little bit about the upcoming Money Tank event in Atlanta. So make sure you get your tickets for that. It's going to be a great time. I'm really looking forward to it. But in the meantime, busy month this month. I know we got a lot going on. A lot of clients right now in the process of becoming their own banks and really helping them solve those money problems. We're really using the BYOB Vault more and more and more to visualize exactly what your policy is doing for you and showing you exactly how to use it to do things like pay down debt. But yeah, let's get some questions in, and we'll get to answering. But in the meantime, Mr. Craig Yenny.
Yes, good afternoon. Craig Yenny here. I hail from south of Denver, Colorado. And like Brian said, I think it's summer already. We didn't get a chance to see a lot of snow this year, so it's just very dry, but kind of miss it. But anyway, looking forward to joining you all today and ask me anything. Ask us any questions about infinite banking, how money works. We'll do our best. And with that, I'm going to pass the ball on down to Tess and the cats.
Hey, it's Tess, and you'll only hear one of them, and he is talking today. Our weather here, it's like Jekyll and Hyde. It was 20 this morning when I walked because I'm in a walking challenge this month, and it's about 50 right now. But we swing like that every day. Great to be here. Glad to answer questions, and looking forward to getting you all your own banking system. Now over to Jason.
Oh, you had it, Tess. You had the point right. Hello, everybody. Happy Wednesday. Always grateful to be here with your questions, with your energy. We appreciate it. Ask us questions. Try to stump us. See if we can have something that we haven't heard before. That'd be cool. And just grateful to be here. I'm down here in the City Beautiful with Spiffy Snaggy all dressed up while he's gone out and meeting all the locals. So
he's trying to bring Miami Vice back.
He's done it. He's done it. He's looking very Crockett.
Oh, he's in the right state at least. I mean, there you go. All right, we'll go ahead and start with the first question here. But as always, go ahead and get those in the chat box there. All right, this is from Discugio. It says, policy owner, I have a LLC taxed as an S Corp and wanted to know if I should keep the same policy as a W-2, switch over to the owner side of it, me company, or do a new one. And if so, how would that work? So there's a little bit to unpack inside this one. Okay, so another comment here says, I am a policy owner already. Okay, there we go. Yeah, so he's already a policy owner, and LLC is taxed as an S Corp, so he has that created. So, but the one thing I'm not understanding here is you keep the same policy as a W-2. Anybody get that or understand what he's referring
Well,
to?
I just
mean, if
think
he has a yeah, go ahead, Craig.
Yeah, I don't know. The way I was reading it, I think he's just kind of trying to figure out, should he have a policy as him personally or one in the business, is what I'm kind of seeing the question as. And if we're off base, just let us know. But if you have a policy owned personally, can you still use it in the business? You could, loan the money, take the loan from the policy personally, create a promissory note with the business, and then loan the money to the business. It's possible that the business could also be the owner of the policy and pay for the policy, but we'd kind of need to look at all the details of how much income's in the company. What is the company? What are you trying to accomplish with it?
The other thing too to think about here is what are you trying to accomplish with the LLC and a policy working together? Because it's not very common that you see an entity like an LLC own a policy. Because the question is why would we want to do that? So I'll actually pose that question to our team here. Why would you want an LLC to own a policy?
Well, for me, it really depends on how it's taxed. He already shared it's taxed as an S corp. If it's a pass through, it doesn't make sense because you're going to get taxes are shared on your personal. But if they're trying to keep the money in the company and not do draws to pay for the policy, that would be one reason. Or maybe that company he has is trying to use the policy to purchase capital, expenditures for the company. So there could be some reasons, but I do like in Nelson Nash's equipment financing model, page 51 of the Becoming Your Own Banker, he talks about how you have a personal policy, you loan it to the business, and he actually uses that personal policy for his supplemental retirement income down the road. So, if it is owned by the business, you'd either have to buy it from the business if you sold the business. So there's just a lot of things to think about down the road too.
Yeah. And one thing a lot of people are thinking about when they're thinking of an LLC and a business owning a policy is taxes. They're trying to get deductions, so deducting the premiums of the policy on their tax returns. But in reality, you're creating a situation that could potentially be an issue down the road. Now, this is not tax advice. We're not financial advisors, not financial advice. But definitely, if someone's thinking about that, I recommend to go talk to an attorney, a business attorney, someone like that can help you with that. Because if you ever close that business or you sell the business, there can be a taxable issue because all of a sudden, all those dollars that were never taxed, the IRS is going to want their money some way, shape, or form. So you guys got to be careful about that. So, yeah, it's a good question though. And then the other thing too that is key employee insurance. So another reason why people have an entity own a policy is that you have like a key employee. That's typically for larger companies, by the way, that have employees and their business is going to be around for the next 5, 10, 50, long time probably, right? But yeah, so you can get a policy on another employee with the company owning it, and there's agreements and stuff that you have to have in place between the employee and the company, but that's another way to do it. But once again, you have to have an attorney involved in that or a legal side involved. Good question. All right. This question here is New Beginnings. Do we have any lenders willing to do 48 months terms? So a 48-month term, 12% fully amortized. So are you asking if we have lenders or are there lenders that do that? Because, yeah, of course, there's lenders that will do that all day long.
Dragon Money Club.
Yeah, it depends on to be honest, it depends on what the loan is for oftentimes, because what the loan is for is going to determine the collateral. So a lender, if it's a bank or a person, they're going to look at the collateral. How are they secured? How are they safe giving you that loan? So it's the underwriting is what I'm referring to. But yeah, I mean, I've borrowed money similar to that before from a private party. So
some people
yeah. Oh, yeah. What's the loan for? I guess that'd be the question. What's the loan for?
And if he's referring to the 48-month term, sometimes people prefer a little bit longer time. Some people want shorter.
Yeah.
Just connecting to the right person.
There we go. All right. Question one of many. I love that. Yeah, get those questions in there, Don. So Don's asking here, should I place my infinite banking policies into irrevocable trust? So first and foremost, that's financial advice right there. So the question, can you? Yes. Should you? it depends on what you're trying to accomplish. If it helps you accomplish your goals, then by all means, that would be a good strategy to look at. What's more important is how that trust is structured. That's a very important thing. And you're talking to an attorney, a trust attorney, they're going to be able to give you that advice. So I got to actually go pull up my trust. I don't even remember how mine is structured. It's been so long. But I mean, what kind of trust do you have, Craig?
I have a revocable and I also have irrevocable. So I've got a couple different pieces, and and some of my policies are still owned by me, some are still owned by the trust. And to your point, it just kind of depended on how you're trying to use the money. So it can be owned. So you can always change the owner and the beneficiary. So that is possible, but then there needs to be a reason and a purpose behind why you want to do that. But yes, you can do that.
Yeah. Yeah, it's funny. I have I think one owned by trust and one not, just because I haven't moved it over yet. But like my reasoning for moving it over to a trust is so that the proceeds can then be held by the trust upon my graduation or passing, and then continue to perpetuate the infinite banking cycle for that next generation. Because I can hope that my kids will do it, but by having a trust sort of involved, I'm more secure in the fact that they will have to go get more policies, if that's what my trust is designed for. So,
Brian, in that instance, can you just have the trust be the beneficiary and you still keep ownership?
Say that again.
In what your example was, that you want the money to go into the trust after someone passes, so then it's inside the revocable trust that you put the rules on it, right?
Oh, yeah.
So can't you just own the policy and have the trust be the beneficiary?
Mm-hmm.
Okay.
Yep.
So what's the advantage of moving it inside the trust as ownership? That's what I was just wondering. What you just described.
Oh gosh, that's a great question. I asked this question years ago and I got an answer. I don't know if I can recall what exactly the answer was. So some people believe in it's for privacy and all that kind of stuff, but I mean, it's a private contract already in the first place. So I really never viewed it that way. The part of the reason why I did it was if something happens to me, and my wife is also part of the trust and the trust owns the policy, it was something about giving the other people involved in the trust access to the policy, so that it's not just owned by me. And then, that's what it was. Have you ever heard a number it's an amount of death benefit that they believe is out there that's never been claimed?
Ooh.
Because it happens where someone passes away, the insurance company doesn't know who to contact, or the insurance company is not aware if they're passing right away, or the beneficiary is not there anymore. They don't know who to reach about the death benefit, and so the death benefit goes unclaimed. And so part of it being in the trust was so that if you have lots of policies, they're all owned and located in one place. And then so like the trust documents list all the assets, it lists all the policies. So the trustee can see them all right there. Otherwise, they're having to go hunt for them potentially. That was the reason I was given years ago as an option.
So the way I look at this is, if you have a revocable trust, I would not necessarily make that the owner. I would just make that the beneficiary, like we talked about. So you die, death benefit goes into the revocable trust. There's instructions on what you want to have happen to it there. Really, the only thing revocable trust is going to get you is keep you out of probate. And then if you have irrevocable, why you might want to have the trust own it is now the trust pays for it. The trust can use the cash value for other investments, other things. So everything's kind of in that box. So it really just depends on what you want to do with that policy. And if you have multiples, kind of like what my strategy's been, I've got some on the personal side and some on the trust side.
Makes sense.
And I know you spent a lot of time kind of navigating all that, right, Craig? You knew exactly what you wanted with the trust. We hear, when we're talking about these structures and stuff, we hear it all the time on our calls where people are rushing to get a trust because they think it's going to do this or save taxes or do all these things. You really have to be really clear and intentional about what you're trying to accomplish. And you need the guidance of someone that's going to be able to give you that legal advice, right? And that's not what we're doing here, by the way. So no legal advice, no financial advice, no tax advice, but really being clear. And I was always impressed, Craig, with how you thought through all of those things while you were navigating that a couple of years ago. So
yeah, I lost some hair over it, but you got to figure it out.
Yeah.
Well, I'm still in the analysis paralysis. I've had 4 or 5 conversations around trusts and different things, and just haven't felt like it was exactly what I was looking for yet. Like it didn't make sense to what I'm creating for our family yet. So,
and I'll be honest, you have to be careful with trust as well. I mean, talking to the right person is extraordinarily important. I had a client that reached out to me for infinite banking, had a trust, and it was involved with multiple real estate deals. There was lots of family involved. But what ended up happening is the gentleman I was speaking with, he had moved in his asset, his home, by the way, his personal home, into a trust. He was not the owner of the trust or involved in the trust, really. It was his parents' trust. And I'm looking at this thing, and I said, hey, do you realize that you just moved your home that you own outright into the trust? You changed ownership, and now you don't own it anymore. He's like, what do you mean? I go look at your title. The title was in the trust's name. He wasn't on the title anymore, and he completely transferred it. And so if something happened to, whatever, he would lose the home. And he didn't realize that. And if you've ever been, gone and looked up trusts, what you'll start getting is all of these ads for people that are wanting to do trusts for you. And they'll charge you $5 or $10 for these special kinds of trusts. And he got hooked by one of those. And it was so bad that he ended up dismantling the entire thing, lost about $10,000 he paid to have this special trust done. And he almost lost his house. So to be very careful about that. You want to work with someone who is not trying to sell you a $10,000 trust package. Those can be very dangerous from what I've heard. We can give you some people we work with, but yeah, be very careful. So, all right. So Jessica's got a good question here. It says, is there a tutorial for the vault anywhere? Craig?
Yes, there is. So Jessica, there's a couple things. If you're a subscriber already, when you log in, there's an instructions page. You can go in there. There's a lot of little videos in there, but you'll also see something called Cracking into the Vault with Craig and Marius, and that's a bi-weekly session we do. There's probably 7 different videos in there of just a bunch of training on the vault. So if you don't get your answer there, then just hit us up in support and we can help you out. Yeah. Now I noticed your question said you don't have to upload a policy to get started, but if you're working with someone on our team, let's say you're working with Jason, myself, Tess, Brian, we can get your policy loaded in there, or we can get you a policy to load in there while we're waiting for yours to get finalized. But you don't have to have a policy in there to get started with the vault.
And I'd also mention, I think it's 9 down on the left. There's an area where all the previous Cracking the Vault videos are.
Yeah.
I just don't remember what the line is called. Instructions.
Yep. Okay. Yeah. So once you go into instructions, the very first one is the Cracking of the Vault. It'll link to all the videos that we've done. And then within that instructions page, if you want to learn about the debts, you want to learn about policy updating, you want to learn about the investment tool. So it's all in that instructions page. Yeah. So if you do have questions and you're working with one of our money mentors, you can get help there, or just put a question in the support and we'll get back with you.
And for anyone who hasn't played around in the vault, there's a couple of kind of cool areas to play called Ask Chris AI and Ask Chris Yvonne AI.
Yeah.
And then one last thing to mention on that, if you have a preliminary illustration, because it says you're in the process of starting a policy. So if you have a prelim illustration, you can use that and load that up into the vault and start, running numbers, scenarios, all that kind of stuff. And then I'll just hit on this question right here that's come here. Cat, so Xena Lily Cat says, I've been watching all the vault videos, pretty good. Just don't have a policy loaded because it says I need to upgrade. So Craig, you want to address that?
So there are different plans, and you may have subscribed to what's called the Debt Blaster plan, and that's really for managing debts and velocity banking. The next tier up is the portfolio plan. That's where you can do all the infinite banking, velocity banking, debts, investment tools. So that may be where what you need to do is get to that next subscription level. And then Jessica's saying her instructions page is blank. Maybe try a different browser. I don't know if you're on like a Safari, but sometimes browsers act weird. Maybe just try Google Chrome, but yeah, there should be content in there. So if there's not, yeah, definitely hit us up in support and we'll take a look at it.
Yep. And then since we're on the vault topic, I'll put this one up as well. Tall Joe. So Short Joe was saying, and the vault is really for debt, right? I have 2 mortgages and no other debt. So what's in, Craig?
Well, the vault is what we call the operating system for our infinite banking. So it does have a debt section in it. It also has a policy management section in it, and also for loans. So if you're taking loans to, buy a car, you can structure that, pay it back. And then there's also a tool we came out with about a month ago called the Gain Projector. And that's if you're using either policy cash value, you might be using lines of credit cash, and you want to run through and model out some investment strategies. That's the Gain Projector. So it does all 3 of those things. Yep.
Cool. All right. So this Dagio is saying, I put in 10K of premiums. 10% is taken from a third party. 9,000 is left. When I take a loan out, will that be the entire 9K or 90% of it? So 8,100. So, I mean, so he's saying if he puts in 10,000 as a premium. So first off, we got to address the first part before we get into the second part. Mm-hmm. So anybody want to address the math on the 10,000 premium?
So Brian, are you thinking premium in terms of premium versus dump-in?
Yes.
So Jason, I don't know if you want to take it. You were going to say something.
No, I mean, I'm good with anybody answering it. I want to know, like, what is the Stagio trying to accomplish? Like, is that the plan he set up? Is he doing 10,000 in annual premium deposits? That would mean that this was a 90-10 design, right?
That's what I was getting at.
Or is that a $10,000 dump in? So, and then you're saying the entire loan amount, at least you have the understanding, which I love, that you can borrow up to, with most carriers, up to about 90% of whatever the cash value is. So that would be the right amount that you can borrow, if that's what you're asking.
Yeah. So my policy, I can borrow it's more than 90%. Whatever they state the amount is, it's like it's like 95 right now, I think is what I was able to borrow.
Yeah, as they get more mature, like I've got one that can take about 98%, but in the earlier years, 90% is a good number to use of the cash value that's listed. Now, the other thing to think about too is if, let's just say you're doing a $10,000 dump in, of that $10,000, 90% of that should be available within the first 30 days. Then when you do the premium, a lot of that's going to depend on how the policy was structured. So that premium portion that you put on, say you're putting in $1,000 a month, could be 50%, could be 60%, could be 70%. So that's going to be a little more variable, but the dump in's usually about 90% in the first 30 days. The premium is going to be based on how that policy was set up in terms of the paid up additions to the base cuts, percentages, whatever you want to call them.
Yeah, because there's some structure in between the funding of the policy and taking of the loan. There's policy structure that is unique to you. It's unique to the individual, the company, the policy, all these things. So 30,000 foot, correct. But once you get into the details, whomever's setting up your policy should educate you and make sure you understand that structure so that you understand how to go from A to Z, how we're doing that. But generally speaking, no, that is a good take on it. All right, Don has a good question here. It's an interesting one. It says, I have IUL agents approach me often. So I'd be curious, Don, as to how they're approaching you. And then they claim it, so they're claiming an IUL is better than BYOB. Well, be your own banker is the infinite banking concept that uses a policy, which could be an IUL or a whole life, by the way. Can you tell me why Bobby, I'm assuming you mean BYOB, is better for an older woman and her kids who are in their 20s? There's a bit to unpack there.
No, this is an hour-long conversation.
Don't you guys miss Chris on these days when we had the IUL questions? You just watch him, his head catch on fire.
Yeah.
It's just a matter of risk, right? And I'm sure they are approaching you. I mean, it's a different approach. Like we're teaching, educating, giving our best stuff away for free so people can come have a conversation with us and we can solve your problem, right? So whether you're 20 or whether you're 50, 60, 70, the guarantees and the control that you have, like you don't have the risk you do with an IUL. So we want to help you transfer away your risk to the insurance carrier versus in an IUL, you're assuming all the risk. Like that's step one. And there's a lot more to unpack, but I think I like to keep it that simple, is where you're assuming all the risk when you do an IUL. You like your kids in your 20s, they'll look awesome now, but wait till they're my age, wait till they're older, wait till they're older than that. Like that 1 year renewable term just gets more and more expensive every year. So
yeah.
I think too, when she's saying, can you tell me why it's better for an older woman? If you want the guaranteed part, which is what the whole life system is, it doesn't matter what your age is, you're going to want to go that path. If you go IUL, just like Jason told you, that's connected to the stock market. So regardless of whether you're 25 years old or 85 years old, you're taking a risk with an IUL.
And it also depends upon what she means by older woman, because we have clients that are up in their 70s.
Yeah.
So keep that in mind. But the thing here too, when you say IO people are approaching you, I believe they're approaching you to sell you something.
Yes.
They're selling, pitching, pitching interest rates. Oh, it performs better, blah, blah, blah. You don't really hear us talking about that kind of stuff. We're actually talking about the infinite banking concept and how to use it to be your own bank. Okay. The policy is the engine that allows that to happen. It sounds like the IUL agents aren't even talking about that happening. They're actually just talking about insurance. So are they educating you on infinite banking, on how to be your own bank and how to use it and how to accomplish your goals? In most cases, I've heard the answer is no.
Yeah, and there's a few approaches I would take if someone was coming to me and trying to get me into an IUL for infinite banking. One, the first thing I'd ask them is, well, tell me more how you are using your IUL for infinite banking, because you're probably going to get, kind of a look like, what? I'm not. But here's the problem. And I've looked at a lot of these IULs. Here's the problem. I just looked at one this week. The gal is putting in $24,000 a year. This is their first year. The cash value accumulation side shows that she's going to have about $20,000 at the end of year one. But guess what she gets to use at the end of year one?
not very much.
$3,000. So you're putting in 20,000 and you have 3,000 to use. Sometimes I would say in a lot of cases, those IUL agents are not telling you that, oh, by the way, if you're going to use this for infinite banking, you only have a fraction of the cash value available. Now, the other piece I'll go to is the infinite banking concept was originally brought to us all by the great R. Nelson Nash, wrote the Becoming Your Own Banker book. There's a whole think tank around the Nelson Nash Institute. And guess what? They specifically say, if you're part of this group, you're part of the infinite banking concept think tank, the group, we prohibit you from using IULs. It's not because they're trying to be like, you shall not. It's because they've proven that it just doesn't work. And like Jason said, it adds all the risk to you. From a banking system, you're putting in a lot of money. You don't have much access to it. And even in this IUL I looked at this week, they're projecting about 6.5% every year from now till the end. Now let me ask you, when has the market ever done 6% every year with no down years, always up, always continuing growing? It doesn't behave that way. And that's an average. So there's just a lot of funny math in there, but it's not going to turn out the way it was illustrated. It's a lot of risk on you. The cash value is low. The insurance is going up every year. When you're down at a 0% growth and your insurance cost goes up, where's that coming from? Coming from
Craig, the thing you said that was the strongest of everything, and I'm glad you're here, was, hey, Mr. Mrs. IUL person, how do you use this in your life? Because if you ask any of us that question, I can walk you through all 5 of my policies, why I did it, what the outcome is, what's happening in them, how the cash value's grown. It's just a different game entirely. And like Brian said, it's a system, it's a process. Like, we're teaching you how to use the system. It's become your own banker. It's a verb. It's doing the thing. It's not buying a product. It's getting something that's going to make your life better by getting out of the regular system.
Yeah. And she has some follow-up comments to this, which I'll cover here because they're important to this conversation. So she's saying, I'm 60, so for infinite banking, still very young. I have 4 infinite banking policies, so 2 in her name and 2 for kids, the one that in their 20s, I'm assuming. No, they aren't being used as infinite banking policies, just as insurance policies. The IUL agents, she says, are stating that that's better because it's based upon the S&P at 16.5%.
Which means it's an IUL.
Yeah. But I mean, I've never seen an IUL that returned a 16% number.
No, there must be. This is the second time I've heard that number, the exact 16.5% number. I had it on a call yesterday when I had a rock star of a real estate woman and investor come in, or broker come in, that was 71. You can talk about energy and amazingness, but she was like, yeah, my friend keeps telling me he's getting 16.5% in his policy and he isn't paying taxes on it. I want to know how that's possible. I'm like, it's not. It's something's going to go very wrong with that at some point, but I don't know what to tell you. But that's the second time I've heard that number. So maybe, I don't know. Any other thoughts on that one?
Well, I think even, and we haven't mentioned it in a while, but like the Kyle Busch, and look online and research, because there are a lot of people that were promised things that didn't happen and it turned into a lawsuit later.
Yeah, that 60.5 kind of throwing me because I've looked at, we've all looked at lots of policies and IULs, and I've never seen anything that had that kind of return there.
Right.
Because they have a cap. I mean,
and
that's kind of a weird thing.
Yeah, and what is that S&P based off of at 16.5 over a 2-month period? Because over the long term, over a 30-year period, with all the ups and downs and averages, some of the best market rates over a 30-year period has been in the 10 to 11%. But when you have the drawdown effect, which means, let's say the market drops 10%, you got to go up 11. Market drops, 30%, I think you got to get up to 50. So you have to go a lot further up than you went down just to get back to zero. And so I don't know. It's just there's so many variables and so many risks for infinite banking. IULs are just not the tool that we prefer to use, and it's not supported by the infinite banking group. And so that's just something to be aware of. I mean, can it be used for something down the road for retirement? I mean, as long as you manage it, perhaps, but for banking, it's just not the thing to use.
Yeah, and and math is math as well. And so Craig has done the math many times, and it's just, they don't, and you can pass that, by the way. They just don't do what they say. So there we go. All right, so this one is from Synoptic Trader. So she's saying, or they're saying, each case is unique, but regarding seniors buying a policy on adult child and hoping to use it to invest, what are the limits? Is it limited by the senior's life expectancy? Probably cannot get same death benefit a child could get on their own. This is a good question, by the way, and the answer to this question has changed over time. So, and I think there's some more parts. If anybody wants to answer this one, I'm going to go through the rest of the questions to make sure there's some more parts to it.
One, getting a policy, like, unless there's an insurable reason for, an adult to take a policy on an adult child, and you have to be able to show that with a letter, right? Or some reason that you're presenting it to the insurance company that there's an insurable reason, whether you're business partners or maybe, that adult child lives with you and is helping take care of you and providing services, and there'll be a big loss if they were gone, something along those lines. So that's that's how that would be limited. I've had the carriers tell me quite often, like, why does this, 60-year-old man want to own a policy on his 30-year-old son when he's independent? And so most of the time that the son would have to get the own policy. I mean, you can do, again, not giving advice, but I know like you can gift I think it's up to 18 or 19,000 a year now. You can gift your children money that wouldn't be taxable that they could use to put in a policy, but you just have to have that conversation amongst yourselves.
And Jason, we've talked about this internally. I haven't tried it myself, but I did look at state regulations that say insurable interest exists if there's love and affection for a blood relative. And so, from an insurance company perspective, you could say, well, there's love and affection, so there's insurable interest, but they could still come back and limit you to say, okay, we're going to allow that, but it's a very small policy.
That's what we've kind of talked about internally. I think that I think Linus told us it was like based on like $100K. It was almost like a grandparents policy, where they say sure, but like it's $100,000, right? Which if your adult child's 25, like that's a couple $100 a year or whatever, right? Like it's not going to be that much that you're able to get into the policy.
Yeah, so
still valuable, but small.
Yeah. So here's the follow up to that one, saying if living in house owned by a child and depend on them, some possible to get 15 years of part of child's income, something like that. So a death benefit. So yes, potentially. But then the question is where I would go with this one is as well, if you're going to get a policy on them, they're going to look at you for the one financing or funding the policy as well. So is that, because in this situation, I mean, they could go get the policy and have you be the beneficiary, because really what if you're thinking about like having a financial loss if something happens to them, then it's the death benefit is the kind of the focus then. So they could own it, you could own it. It doesn't really matter.
I think the underlying fear might be, Brian, like, hey, I don't know if I can get a policy on myself. So I would first want to know what was going on with you that you didn't think, whether it's age related or health related or something else, and take that to preliminary underwriting to really find out, because it's super valuable when the parent actually has that protection on their body. And there's really not a big difference in the cash value if you are healthy and able to get that policy, because you might be thinking, hey, it's cheaper to have it on someone that's 20, 30 years younger than me. And that's not necessarily true. Depending on what you're trying to do, the riders, the different things, but I think having that death benefit on your body is super valuable when it comes in terms of legacy and banking and using all the things.
The last comment that they just put in here says, thinking in death benefit mostly because it affects cash value and MEC rules. I don't know if I would probably state that I wouldn't say the death benefit affects cash value. Cash value is part of the death benefit, and the death benefit is just part of the MEC calculation. But you're definitely thinking about it the right way, though. I would just recommend scheduling a call with someone and just going through your situation, and we can give you some very direct answers.
Yeah,
it's very unique. There's a lot of variables. So, I mean, it sounds like you have the right thoughts, like Brian said. So have that call. Let someone meet with you one-on-one and really see how individualized we can make this for you. So, And I owe Carrie Swanson, I owe you an apology. I saw your name and I'm like, oh my God, she sent me an email and I haven't responded. So I'm going to take your question because it's a great question.
Which one is it?
I'm also going to respond an email. It's not there. It's right here in my inbox. Oh. I just saw her name and I said, oh my God, I'm so sorry, Carrie. So you asked about, I like to teach folks how to be the banker, how to actually do the verb of banking. So going in, adding extra PUAs in, we talk about it a lot here. Like, why do you want to do that? It always gives you more death benefit first. It always gives you high cash value. And it's also going to increase the likelihood of a dividend. That's what your dividend buys in most banking policies, is more paid up additions. So when you can add extra in, it really makes sense. Like Craig knows that, hey, don't forget to pay the premiums, right? Or don't forget to add the PUAs. So Carrie, you asked me the question. It's 3 times the base of what your base, which is the whole life portion, is. So for yours, I'll give you the specific answer in an email, but we build it in so you have enough room. So you can go down as low as 4,900 a year. You can go up to 12,000 a year. You can go above that, another 7,200 in additional PUAs. And I'll give you the math on it as well, but it gives you a little bit of room to go to what the goal was and go above if you have additional funds come in. So.
And Carrie's a Michigan girl.
Yeah, she's awesome. She's awesome.
Cool. All right, let's see. Roy, so it's I'm getting that correct. It says, how do you go about sharing this with people who don't know about infinite banking? I have a policy, and it seems like I just fire hose people with information when I tell them about it, and it's not effective. Yeah, I can definitely get that, because you're excited about it, you're hearing about it, and yeah, people get kind of overwhelmed sometimes. But I mean, I'll share how I do it, and then everybody else can share how they do it. So I have an email that I send to people, whether they get a policy or not. I just have an email that I send that has my 90-minute presentation on infinite banking, and then some other just resources and things. I just send that to the client, and they can just forward that on. That's typically how I do it, because now they're hearing about infinite banking from somebody that's not like a relative or a friend, and it's actually received differently from what I've seen. But I don't know, how do you guys do it?
I think you can't expect them to buy on right away. I think you have to live the example and then just kind of spoon feed them. You know, it's like learning to walk. You have to take it a step at a time. Like sometimes I'll encourage people to do the blueprint training like we just recently had, or purchase the replays or certain YouTube videos that I like. But I will say that somebody that is now currently has 3 generations, it was 5 years before they ever stopped believing that I wasn't being scammed. So I think you just have to understand that you're excited, but it's going to take steps before somebody is going to join you. So just give them enough information that they can get their feet wet, live the example, let them come to you with questions, and then the door will start to open. But it's not your timeline, it's their timeline, and you have to respect that side of it.
Yep.
I see Craig going through some good thought process. What do you got, Craig?
I don't know. It's tough, because whether you're talking about politics, money, or sex, relationships, whatever, people don't want to talk about that stuff. And, you know, I think about my own journey. When I first learned about this, I was so excited about it. It's back in 2007, 2008, and I was telling everybody about it. Just like you, Roy. I'm like, I got to tell everybody about this. It's so cool. Nobody cared. My own family didn't care. People I worked with didn't care. And I can remember, you know, every year, you know, I spent 31 years in a W-2 job, and every year, you know, you got the benefits discussion. Like, oh, are you doing the 401k? I chose not to. I unplugged from it. I'm not doing it. It's like, well, you're not doing the 401k? No, I'm not doing the 401k. What are you doing? And I'd tell them about what I'm doing. Oh, ooh, that sounds like a scam. Out of all the years of the people I met and worked with, I think only one guy ever took action, and he actually, you know, got some policies. But it's just weird. People, unless they're receptive and they want to learn more about it, you're not going to be able to push that horse to water. You're going to drag them and try to get them to the water, stick their head in the water and pull their tongue out. And
I'll share a story that I find extremely funny. My mother and I generally walk every morning at 5 a.m. So she was also one that thought this was a scam. And one morning we're walking and she stops me and she goes, I think I get it. And I'm like, you get it? Like, what happened? And she goes, I saw a movie last night. And I'm like, okay. She said, it's called The Wrong Man with Henry Fonda and Alfred Hitchcock. And in the first 5 minutes, he went to the insurance agent and found out he had cash value and that he could take a loan on it. But the insurance agent told him it's his wife's policy, but he could come back and they'd confirm it. And so I dug in a little bit more. This movie was from 1957. My mom didn't believe me, a statutory accountant in an insurance company of 35 years. But Henry Fonda and Alfred Hitchcock, 1957, they know their stuff.
That's roughly when Nelson Nash, if I remember right, it was either 54 or 57 when he became a fan of Austrian economics, which was how many years before the book was published. Like, I think about his life and how much he went through before he came to that realization. It's just really fascinating. I'll give you this. Who asked that question? I don't see the name anymore. But whoever asked that question, I love the enthusiasm. We've all talked about our struggles with sharing our enthusiasm. I would offer to you the best way to always do anything is ask them questions.
Yeah.
Ask them questions like, hey, you seem to be doing really well financially. Do you ever have the feeling that you could be doing better or there's more? Or any other version of that, any other version of a question, like, how are you doing financially? What's working for you? What's not working for you? Any way to have conversations to get them talking so you can understand their pattern, because what you're offering, like Craig said at the water cooler, you're saying, hey, the system's broken. It's not set up for you. Ask who's getting all the money. And it's crickets, right? Because you sound like a crazy person. So instead, you have to be like, look, if you want out of the system, this is the path. And Craig, what I was thinking about, I love your take on this because I'm just curious. Carson and I were going back and forth after our meeting a couple hours ago. Was Carson's like, wow, man, because I send him breakdowns of the vault. This is the plan. This is your specific plan. And like after every call, and he's like, that's too much information. Like that's way too much that you're giving people. And I kind of agree at times, right? I give them how to read Nelson's book, how to watch the Rethinking Banking video, other resources. Like I tend to give a ton and specific feedback on our conversation. But I think sometimes we're so excited that we're giving too much information, right? And I don't know what the balance is. Like, how do you balance, like, how deep do you want to go down this rabbit hole with me? And hey, I just want this to work.
I think you said it, like asking the questions, and they'll let you know when they're ready for the next piece.
Yeah.
Cool. All right, we'll dive into some more of these questions here. All right. Zena Alleycat is saying, if I were to come into a small lump sum of money, 20 to 30,000, can I dump it into my current policy, or do I need to get a second policy?
It depends. It depends.
Yeah.
You can find out if you're working with us, work with your implementation agent or your agent, your mentor, to find out how much additional paid up additions you could put into that policy.
Yep.
And then we can help you come up with a plan. I was going to make a comment about thank you for watching Craig's vault videos. And I think Craig wants to hear how could he do better? Because you said they're pretty good. He wants to know how you can make them fantastic.
And they're really good.
He wants to be really good.
Yeah. But for Zena Alleycat, but yeah, generally speaking, I mean, if it's not designed to accept an unscheduled chunk of change, then it usually cannot go in. But once again, as Jason said, yeah, I mean, there may be some room, but without seeing the illustration, the policy, that kind of stuff, we just don't know. But that is another reason why people do get second policies, is because of that. They have an unforeseen cash event.
But it's worth the call to find out if you do have room in your PUA, and if you don't.
Yeah.
And even with that, I had a gal that she had a big dump in a policy. She's about in year 3, selling her house, retiring. It's like, hey, I'd really like to get this big chunk of money in my policy, but I don't want to start a new policy because I'm in retirement. So we went back to the insurance company. They already had a term rider in there, and so it allowed the room. We just had to get it approved. So we went back through it, basically a light underwriting process, and they approved her to dump it in.
Oh, wow.
So it depends on the company, depends on, the structure, but we were able to get her existing policy set up where she could just put that big chunk of change in it and not have to start a policy with more premium.
See, it depends. That's our answer. It's a good answer.
Favorite word. It depends.
Yeah. And then we got some IUL questions. So Synoptic Trader is saying, IUL death benefit and annual premium, I think, are higher. Not generally, no. It's all about design, the company, the product. There are so many factors that go into a death benefit and all that. I wouldn't say that an IUL is higher or not. It's all about structure and design. If everything else is equal. And then this one is another one saying, as you get older, premiums in IULs go up. Well, personal experience, mine are flat. By the way, I have experience with these because I was sold something like this. It wasn't a true IULs and VUL, but the premiums don't go up. They're flat. The death benefit and cash value go to 0 along with the premium while I'm still alive. It's all my schedule. I can go look at it right here. If I want to keep it, yes, the premiums have to go up, and they go up greater and greater every year. I can't remember at what point in my life, but yeah, if I wanted to keep that policy in effect, I'd have to be paying out the nose down the road. So
yeah, I helped a 71-year-old who saw this happen in real time. He was 12 or 15 years in the policy. So he's was past the surrender. He had a decent amount of cash value, but he's a business owner in California, and he has like 11 like within his family and the business and different things. And so he transferred that one to a whole life. We were able to get him approved. So he escaped that, but he saw it, what you're just saying, Brian, the going up, the premiums going up every year, the cash value going down, the death benefit going down. And he was like, whoa, what happened? Like, what is this thing? So he didn't see it until he saw it. So he started in his 50s. And by the time he was 71, he's like, what the heck?
They need to disclose. I wish they would make it a legal thing that they have to disclose that. Because how many people have you talked to, Jason, or any of us, talk to somebody who has an IUL and does not know that that's going to happen? They're like blindsided all of a sudden that when we tell them, it's like, well, did your agent tell you this? No. Gee, I wonder why.
I still like to believe. I mean, we've had some people in our trainings that do it the right way with clients. Like, it's just another product.
Right.
So it's not terrible. We just, not for banking. That's all we're saying. Not for banking. It's too many variables, too complicated. But I know, I've got to believe there's some people out there that do it right. We just see too many lawsuits, too many problems on our calls, too many things with IULs. That's Shauna's next question. That's what I'm getting into. So Shauna, I was trained when I first started by my mentor because he was exploring this. He was, had his first policy since 2007, knew Nelson. He's a fiduciary, and he was looking into IULs for banking just to see, like, he wanted to understand it. And so I was trained in that when I first started back in the beginning, and I just never could come to sell one. And then once I became a practitioner, I believe we signed something that says we can't ever do that, right? Like, we say, we agree never to use an IUL once you become a certified infinite banking practitioner. So yeah. I don't believe for banking, I would never even sell one, buy one, use one, unless I learn something different that makes me change my mind. But that's how I would approach it.
But would you make more money selling those IULs? I think is what.
Oh my God! Yeah. I would have already hit my goal of being a millionaire in this space already by doing what I'm doing with the amount of people I talk to and how I help people. Like, I'd be making what? How much more? I never even tried to figure it out.
It's not truly 7 times. Because on an IUL that's infinite banking, the commission is less, but it's a huge number more. It's a big number more.
It's got to be a multiple of 3, 4, 5 times, right? More per policy. I don't really know the answer. I'm just making stuff up. So don't listen to me. Go verify this. It is a live session, so I'm just sharing what I'm thinking.
Somebody say IUL.
Yeah, there you go. Hi, Stephen.
Yeah, did Shauna tell you to come back? You took your jacket off, man. What happened?
Stretching out a little bit. Got some things going on. Yeah, man, IULs are something else.
Yeah, we've had a few of those questions today.
It's our teammate Shauna in there poking those in there.
Yeah, I like that. Poking the bear, poking the bear.
Yeah, she's having some fun with us.
Yeah. All right, we'll blow through the rest of these questions here. All right, Zena Alleycat is saying, what about an adult taking a policy on a parent? This comes up actually more often than you think. I don't know. Anybody else have that recently come up?
If you can get it approved, it's really worth doing. You're already creating that next generation of a waterfall coming back, right? When they pass, you're creating a multiple of whatever went into the policy. Yeah. So it's about the insurability interest, but that's a good play if you can get it to work.
Mm-hmm. Reagan Smash says, Reagan Smash says, I have a lot of people that want to do policies like I did. I have a very hard time recommending it to people because how hard and confusing the onboarding process was for me personally. And then Reagan saying here said, I talked to my mentor only twice, then 3 different people on one call each. Confusing, and I've been planning for this for a year. Friends and family want to talk to this one person, so they... Is there more to that one? Oh, here we go. So they just want me to tell them the one person they're going to talk to. So Reagan, what I would just say is if you have a mentor, someone, just communicate that to that mentor so that person can control the communications. Because we do have quite a few people on our team, but we can do that for you or for them.
Yeah, it's great. It's great feedback for us too, because they're like, the way I explain it to people is like, look, I'm going to be the director of what's happening, but I don't know all the ins and outs of working with a case manager. So that's our application specialist. They're like the concierge to the life insurance company. They're going to make sure that you're getting all the documents, the things from the doctors and different things. And then once your policy is enforced, we also have we have another teammate, or eventually we'll have a new team, right, Stephen? Where now that's going to be someone showing you how to register your policy, how to take loans, how to do the day-to-day things. And like the folks I've helped get multiple policies, it's more about what is each policy for? What's your manageable floor across all the policies? Are we thinking through all the effects of getting new policies? So it's really where our focus is, so we can be experts in that area versus being experts all the way across the board. So.
Yeah, guys, just so you know, and I agree with you, Reagan, it can be a lot, when you switch over to an application specialist and then the underwriters get involved and then you're moved over. So, Craig and I and our team have spent a lot of time on kind of how can we make this process simpler without involving so many people. And so moving forward, you will have, and this isn't quite ready, but later this year, you will have your money mentor, who is Jason or Craig or Brian or Tess on this call. And then you will have what's called the Bankers Only Club that you become a part of. And the Bankers Only Club is there to help you with whatever you may need. And then specific conversations, it's your money mentor. And so instead of having all these different people, you'll have your money mentor and then this club that you can get support in. So I appreciate that feedback, and it kind of reinforces that we're moving in the right direction. Now, private money club is a little bit different. I understand what you're saying there. Private money club is designed for the investment side of infinite banking. So those that are ready to start actively investing in real estate, passively investing in real estate, want to learn more about how alternative investing works and asset protection. So, you're always going to have specialists. Like Jason said, Jason's a specialist in designing these family banking systems, privatized banking systems for you and your family. But, anything beyond that, that's when we would want like a specialist. We don't want to overwhelm you with it though as well. So hopefully in the future, we have more of a cohesive process for you.
Yep. All right. So last minute questions here. So Reagan's also asking, are there banks that will give you a line of credit based upon your cash value in your policy? And if so, what are they? The answer is yes. I'm only aware of Boozy Bank or however you pronounce it, out of New York. I think they're out of.
Yeah, it's out of New York.
Anybody else know of any other one?
I mean, there are others, but that's the main one we're using. So we could get you in contact with them. Now, some of it depends on how much cash value you have, because I think with Busey you need to have 75,000 of cash value. But yeah, there definitely are banks that will give you a line of credit based on the cash value.
Yep.
And oftentimes they're going to be a little bit higher rates than what you would get just directly from the insurance company. But it can make sense if you have a direct recognition policy. It can make sense if you have multiple policies and you're trying to consolidate everything into one easy place. So there are some reasonable approaches to using a cash value line of credit.
Yeah.
It's BUSEY, I think it is. BUSEY, Busey.
All right. Philippe is saying, or Philip is saying, I recently did an investment and didn't do the requirements because of a problem and have never done the thing. Should I, or should I hold back? So there's no way we can answer that question, just being honest here, because we don't even know anything about what the investment or the requirements or the problems. So I can't give financial advice, or we can't, but there's not enough information in there for us to even respond to. Yeah. And I'm not sure if you're using infinite banking involved with this or not either. So,
but we do have a team under our umbrella or company umbrella called PMC Wealth, and they are investment advisors. They can give investment advice and help you look at those types of things, but we just can't.
Yeah, I want to have them hop on one of these calls. It'd be kind of interesting. Let's see here. So Dawn, so she was just clarifying some of her prior comments. She's saying, yes, that's me. She's the policy owner, and her kids who are in college are the insured. So she's the owner. So she's responsible for the premiums, funding the policy, accessing it, borrowing it, all that kind of stuff. Assuming she may have got the policies when they were a bit younger, maybe before they were in college potentially. But yeah, that's a very common way to do it if you can get approved for that. Yeah.
Mm-hmm.
I think we already did this one. Let's see. Any other questions?
I did see one in the chat where they were asking about if it would raise red flags with the insurance company if you didn't have children.
This one right here, yeah.
Is that it?
Yeah. Yeah.
I can speak to that personally because I myself have 3 policies and I was never able to have children. So I picked 3 people, and the insurance company did come back with questions, wanting to know why I picked them as the beneficiary. And then once I explained it to them, they were totally fine with it.
Yeah.
That was an experience.
Yeah, but it won't raise an eyebrow with the insurance company, to be honest, because it's insurance. Yeah, that's not their concern if you're unmarried and you don't have kids at all. It's not really that. But yeah, they will ask about if the beneficiaries don't make sense to them, they'll just ask. But you can always change the beneficiaries after the fact too. I've never had them ask any questions when I've done it after the fact on my policies on the beneficiaries. Has anybody else ever had them ask a question on that?
No, and I've had plenty of people, like Tess said, who are single, no children, and they make whoever their sibling, whoever a beneficiary. It could be a cause, whatever. Like, right? They can choose who their beneficiary is. So
It might probably triggered questions because there was no blood relation. So it just triggered a couple of questions, and then they just moved forward with it.
Cool. Well, awesome. I think we got through all of the questions. So that's another Ask Me Anything in the books. Any other outstanding questions? I've not seen any. Just want to make sure we had a few comments. So I want to make sure we got them all. I think we're good to go. But once again, everybody, we do this every week. So any questions you didn't get answered, obviously pop in next week or reach out to us. I put in the call link here a little bit before, so go ahead and grab that if you want to schedule a call with one of us. And the recording of this Ask Me Anything and all of our prior ones are also in our YouTube channel. They're typically posted there about 3 to 4 days after the event. So you'll see that here this weekend, most likely, if you want to go back and watch that. So appreciate everybody with that. Oh, here's what someone asked for the videos. Maybe this is for you, Craig, by the way. So we asked for some feedback on the vault.
All right.
So maybe adding a few more videos, which maybe some current event scenarios, like focus around people with student loans, other stuff to show how it can work for extreme cases inside the vault could be an option there.
Craig, I have some cool ones if you need them. I have 2 clients I helped this year where they had 1 or 2 student loans, like different kinds of student loans, and then they were sold so often that now they're broken into 11 or 12 or 13 different ones with varying interest rates between 6.23, 6.25, wild how many people are getting their fingers in money trying to make money off like getting paid persistently. So
I've got one that has 30 student loans all broken down like that, little pieces. It's nuts.
Yeah, I had both of them. Like, what is happening here? Like, what happened to like 2 or 3 student loans or 1? And they say, oh, they got sold. It was one Fannie Mae or whatever, right? Or whatever the one. So.
Wow. Yeah. So so appreciate the feedback on that. And also, if you get a chance, watch some of those cracking into the vaults, because that, especially like last week, we had 3 people share their screen with saying, hey, I'm trying to figure out how to do X, Y, and Z. They share their screen and worked on it. So there's a lot of use cases, but we'll improve some of the videos over time and get more use cases in there.
Yep. Well, with that, everybody, we will see you next week. Appreciate everybody and take care.
See y'all.
Ciao.